Sidelines, I'm Trice. Would you love to stop being intimidated and learn how to invest in the stock market? Would you like to know how to invest even with the smallest of sums? $10, $100, $1,000 maximum? In this video, I'm going to show you how to get started investing in the stock market and give you the confidence you need to take that leap of faith to make your wealth grow. If getting richer makes you happy, will you do me a favor and sprinkle some love on that like button, because it helps me more than you know. I'm going to say something that might sound a little mean, but my intention is for you to get the best return possible. I think I know what you want. Tell me exactly where to put my money so that I can make money and I don't really have to think about it. I will give you that information at the end of the video. But if you skip to the end, your return is going to be cut in half, most likely. And how do I know that to be true? Because the average investor has a 30-year return of 3.79% when the market had an 11.09% return. Why this discrepancy? Why is the average return so low? It's not because people are idiots. It's because they don't understand how to think like an investor. And it's not hard. I'm teaching my 7-year-old son how to do it. But let me give you a concrete example. My mother is an excellent investor. And in 2008, she made an investing mistake. Do you remember 2008? The market was melting down. It was terror on the street. Retirement accounts were cut almost in half. Well, my mom was about 59 at that time, and she had been investing for a very long time. And she didn't sell, which was amazing, and is so much better than what most people did, is they sold their investments because they didn't want them to drop any further. But what she did is she stopped investing because she was afraid of the market. And this is why the average investor has such a dismal return. Because of our emotions. We invest according to our emotions. Should I pull my money out? Should I sell? Or even the flip side. Oh my gosh, I think this is a great time to get rich. And our desire clouds our judgment. That, in a nutshell, is why it's so important to listen to the thinking behind the information. If you can understand the thinking, then you will be able to do what I call hold the position. Meaning, when there's fear on the street, you won't sell all your gold. And when everybody says, hey, you can make money overnight, you won't be swayed by that fancy either. So in this video, we will build an investment strategy, and I will give you 3 ways to start thinking like an investor. The best part is that you do not need a lot of money to get started. The most you will need is $1,000, and you only need to get that one time. After that, you can invest $10 or $25 or $100. So the biggest obstacle is coming up with $1,000. Which brings me to my first point in thinking like an investor. An investor knows that the most important thing in investing is to get in the game, because time builds the fortune. Not necessarily the money. Of course you need money, but the thing that makes the wow factor is time. Imagine you were maxing out your Roth. You were investing $6,000 a year and you got a 7% rate of return. In 20 years, you would have almost $250,000. $245,972.95 to be exact. Now, let's just add a little bit more time. Let's say you did that exact same thing and invested over 40 years. You would have almost $1.2 million. Even when you subtract out that extra $120,000 that you paid over 20 years, you're still over $830,000 ahead just because time made you that money. Now, this is the biggest complaint that I have my clients bring up. But Trice, who cares if I'm 1,000 years old and I have millions of dollars? That's no fun. It doesn't take 40 years to build a fortune, but it would take a lifetime if you don't get started now. And that example is not to say that you're going to wait till you're 102 to spend your money. That example is only to show you the massive power of time doing the work for you. Now, if money's a thinking game, like I said, and you want to think like an investor, this is the second tip. Always be investing. This is what wealthy people think. Like I showed you in the segment before, it is time that makes the fortune, and time is ticking, my friend. Now, I don't know if you're saying the things that my clients say when they first start, but Trice, I don't have any money to invest. I have debt, I have student loan debt, I can barely squeak by, I can barely make it through today. And I'm going to show you how to know if that's true or fantasy. I do this with all my clients before they start. I know if I can help them before they pay me any money. And I ask them 3 questions. 1, are you willing to make minor changes to achieve your financial goals? Obviously, that answer has to be yes. Then I ask them, how much is your rent or mortgage? And how much do you make after taxes? What is the take-home pay that you receive in your bank account each month? And if you work for yourself, pick the average. It is calculating this ratio that allows me to see if you have a money shortage, like there's literally not enough money to achieve your dreams. But most often the case is that people have a management of their money problem, that they don't know how to hold on and expand their wealth. This is the skills that I help them develop. And this ratio is going to show you which side of the tracks you're on. And I'm going to take a real life client. I have a client that they bring home about $4,000 after taxes, and then their mortgage is $1,387. So I divide $1,387 by 4,000. Almost 35% of their income is going to houses. The highest this number can be to easily achieve your dreams is 36. If your ratio is higher, you have one of 2 choices: move or make more money. If your housing costs are 36% or less of your take-home pay, and you're still struggling, if there's credit card debt or student loan debt, and it's a management of the money problem. And if that's you, don't feel bad about it. Most people have never been taught how to manage their money. So if you fall into camp 1 and you don't have enough money to think like an investor and always be investing, the question to ask yourself is, how can I make more money so I always can be investing? And if your housing cost is less than 36% of your take-home pay, great. You have enough money to get started. Now here's the $1 million question. You want to ask yourself before you invest, when are you going to use this money? That is really going to dictate what the best investment strategy would be. For example, if in 1 year from now I wanted to buy a house, the best investment for that money would be to let it sit in a money market, earning 1 to 2% interest, because the highest priority would be to preserve the capital. I couldn't afford the risk. As opposed to on the flip side, if I needed the money for retirement and I had 30 years of time before me, that gives me something so valuable. That ocean of time, that 30 years, allows me to maybe take a little bit more risk because I can weather the volatility, those ups and downs of the market, because I'm not going to be afraid that I'm going to sell at a loss. And this is the third way to think like an investor. From almost every investment, that's what I said, for almost every investment, you think long term. And I didn't make this up. I adopted this from Buffett's thinking. When you think short term, there are so many transaction costs. Almost all day traders make no money. Yes, they might have a few great trades, but once you subtract taxes, day trading costs, fees, and add in their losses, they're usually behind for all their effort. And this will serve you well if you don't want investing to be your full-time job, you just want to be really good at it. Imagine that you had a golden ticket and you got 20 punches, and each punch signified an investment you made in your life. And after 20 punches, you weren't allowed to invest in anything else. You would be more thoughtful, you would be more diligent in making sure it's a sound investment, and you would look to make sure if it had a high probability of coming ahead in the long run. This is a hallmark thinking pattern of thinking like an investor. Trice does not try to hot tip stock pick. No. I have a very specific investment strategy that I follow. I know the market will go up, the market will go down, But over the long run, there is a very, very, very high probability that I'll come out ahead. And this, guys, took me a long time to figure it out. A lot of trial and error and a lot of education. Like I said in a previous video, I started investing at 16, but it wasn't until I was 29 years old that I learned enough to know what I don't know. And I don't know if the market's going to go up. I don't know if the market's going to go down. So you have to build a portfolio that can handle both. And adding this time by thinking long term allows the portfolio to handle those waves. Now, if this is your first investment ever and you're a young buck, I am going to make a suggestion. I would recommend that you do it for retirement, because somebody starting in their 20s might only have to save about 10% of their income, as opposed to somebody starting in their 40s who will have to save 20% of their income to achieve the same result, because time builds the fortune. Quickly, I just want to interject. Where are you going to put the money? Not in the specific investment, but what investment firm? I don't make any money from any investment firm, but I really have to give a shout out to Vanguard. This is my favorite feature. Imagine an investor wants to know their compound rate of return. It's actually very difficult to find on Fidelity or Charles Schwab, but on Vanguard, all I have to do is go right here. I click performance for the last decade, and at a click of the button, I can see what my 10-year rate of return is. To me, that is insanely valuable. That, coupled with the low fees, make it a win-win for me. Now the fun part. What should you invest the money in? The truth is, with a $1,000 minimum investment, the options are limited, but they're not bad. And it's actually great when you're starting out. You don't want a million choices. Now, of course, I cannot say go do this. You have to decide on your own if it's right for you. This is just for entertainment, education purposes only. But if I was meditating on it and I had $1,000 and I wanted to start investing, I would zip on over to Vanguard, look at their target retirement funds. A target retirement fund is a one fund portfolio. You would only buy one fund, but it is diversified in stocks, bonds, international, and the sort. And what's cool about them is the closer you get to that date, like if you're looking at the Vanguard Target Retirement Fund 2050, the closer 2050 comes, the more conservative that investment gets. So it's currently at 90% stocks and 10% bonds. Bonds are less risky, stocks are more risky. So that's a great investment if you're a young buck and don't need the money for 30 years. Actually, you don't even have to be a young buck. I'm not a young buck and I don't need the money for 30 years, so that could be a good option for me. But if you're a little bit older and you want something more conservative, you would just pick a target fund with a near date. Like the Vanguard Target Fund for 2020 is invested 55% in stock and 45% in bonds. The 2020 fund would potentially have a lower rate of return because it's more conservative than the 2050 fund. It also should experience less volatility, like the up and down, the heartbeats. The more risky a portfolio is, the more volatility you will see. So you have to ask yourself, can you stomach your portfolio being cut in half? Because like I said at the beginning, holding the position, sticking to your investment strategy through thick and thin, if you can lay your confidence on that, that will help with the emotional backlash of these subpar returns that the average investor has been experiencing. Now, of course, there's an ocean of stuff to know about investing, but I hope that was enough to get you started. And until next time, I kiss you.